What if the stock market were like a moody neighbor who shows up every day with a new crazy offer? Warren Buffett calls The Intelligent Investor the best investing book ever. These 5 lessons shaped his wealth, and they can shape yours too. Mr. Market. And here's where it gets wild. Benjamin Graham's idea of Mr. Market is pure genius. Imagine this. You own a small, cozy coffee shop. Nothing fancy, just good vibes, regulars who know your name, steady profits. Now picture this strange neighbor, let's call him Mr. Market, showing up at your door every single morning. One day he bursts in, all excited, "I'll give you $1 million for your coffee shop. The market's hot." You'd probably laugh. Yeah, okay, noted. The next day he drags himself in looking like someone just stole his last slice of pizza. "Coffee shops are dead. I'll give you $50,000 if you sell today." And the day after that, "Wait, $700,000? I changed my mind? Coffee is trending again." Sounds ridiculous, right? Yet this is exactly how the stock market behaves. Stocks jump, everyone thinks they're a genius. Stocks crash, everyone's panicking, selling at the worst possible time. Why? Because the market looks official. It's on TV, apps, and news feeds. But just like Mr. Market, it's emotional, dramatic, obsessed with fear and greed. Most of the time, it's wrong. Here's the kicker. Warren Buffett, Graham, and smart investors don't panic. They watch, they wait. During the 2020 crash, companies like Microsoft, Apple, and Amazon weren't suddenly broken. They were being sold at crazy discounts because Mr. Market was losing it. Those who stayed calm, they scooped up value while everyone else screamed. Graham puts it perfectly. The market is there to serve you, not to instruct you. The lesson? Don't react to daily market moods. Let Mr. Market throw tantrums. When he's manic and greedy, cool your jets. When he's panicking and selling cheap, that's your golden moment. Control your actions, not his emotions. What would you have done if you saw Amazon dropping 30% in a week? That's your test of patience, and your chance to win. Stop speculating. Here's where most people crash and burn. Investing and speculating might look the same on the surface, but they're worlds apart. Think about it like buying a house. Investing? That's checking the neighborhood, testing the plumbing, visiting schools, picturing yourself living there for years. You care about the long-term value, not just tomorrow's price. Speculating? That's buying the house because your barber swore it's about to triple in value. No clue about the structure, the location, or whether it even has a roof. Just hype. This is exactly what happens with stocks. People call it investing, but they're really just speculating. They chase hot trends, jump on meme stocks, or buy whatever TikTok or YouTube says is the next big thing. It's thrilling at first, until it crashes, and they're left staring at red numbers, wondering what went wrong. History is brutal here. Take the dot-com bubble of the late 90s. Companies with zero revenue, selling nothing but dreams, suddenly soared because everyone believed the hype. Stocks that made no sense skyrocketed, only to crash spectacularly. People lost fortunes because they weren't buying businesses. They were buying buzz. Graham's golden rule? Treat a stock like it's part ownership in a real business. Because that's literally what it is. When you invest, you're buying a piece of a company with employees, products, customers, good months, bad months. Just like any real business. You wouldn't buy a tiny piece of a pizza shop you know nothing about, right? Same idea with stocks. Here's the practical takeaway. Do your homework. Understand the company, its revenue, its strengths, and its weaknesses. Ignore the hype. Ignore the social media noise. Know what it's really worth. If it doesn't make sense, don't buy it. Investing isn't about adrenaline or luck. It's about knowing what you own, why you own it, and staying calm when the crowd loses its mind. Have you ever jumped on a stock just because everyone else was shouting about it? Imagine the difference if you'd paused, done research, and waited for real value. That's what separates the lucky from the smart. Margin of safety. And now, this one might just be the smartest trick in the entire book. Benjamin Graham's margin of safety. The idea is simple. Never pay full price. Always leave yourself a cushion, because no matter how much research you do, mistakes happen. The market can swing wildly, companies can stumble, And sometimes the world just flips upside down for reasons that make zero sense. Think about it like building a bridge. If trucks crossing it weigh 10,000 pounds, do you build the bridge to handle exactly 10,000? Of course not. You build it for 30,000 pounds. That extra buffer, that safety margin, is what keeps the bridge from collapsing when things go wrong. Stocks work the same way. Here's a real life example: the 2008 financial crisis. Panic everywhere. People are dumping stocks like there's no tomorrow. But solid, reliable companies, Johnson & Johnson, Coca-Cola, and others, were suddenly trading far below what they were really worth. Warren Buffett swooped in, grabbing massive value deals that most people couldn't see because they were blinded by fear. That's the margin of safety in action. But here's a trap most people fall into. The stock keeps running higher, and suddenly you're thinking, I have to buy it now. It's a great business. Take Apple, for instance. Even if it's brilliant, buying at an inflated price can turn a great company into a terrible deal. The business is great, but the price matters just as much as the company itself. So here's the practical takeaway: patience pays. Don't chase fast gains. Study the business, understand its value, and wait for a price that gives you breathing room. That's when you're protected if something goes wrong. That's when risk drops and upside skyrockets. Ask yourself this: if you knew you could buy Apple or Microsoft at half the current price, would you wait, or would you panic in fear of missing out? That's your chance to test your discipline and to let Graham's margin of safety really work for you. Pick a side. And here's where most people get stuck. Benjamin Graham insists there's no middle ground. You're either a defensive investor or an enterprising investor. No wishy-washy in between. Think of it like going to the gym. The casual jogger, they stroll in, lift a few light weights, feel healthy, and leave. That's your defensive investor. They're steady, consistent, and not chasing glory. They want safety and slow, reliable results. In investing terms, that means broad, boring, beautiful index funds like the S&P 500. Maybe sprinkle in bonds, set up monthly contributions, check the portfolio once a year, and let compounding do its magic. Now, the bodybuilding competitor? They've got a strict plan, a coach, meal prep, tracking, supplements, and discipline to outwork everyone. That's your enterprising investor. They dig into financial statements, hunt for undervalued stocks, and chase opportunities others can't see. Warren Buffett himself started this way: young, obsessive, disciplined, doing the work most people won't. Here's the warning: the middle ground is where people get wrecked. They chase trends, panic when things drop, and sell low only to buy high again. That's the quick path to losing money and confidence. The practical takeaway is simple: know your style and stick with it. If you're casual, embrace index funds and consistency. If you love research, go all in on enterprising investing, but treat it like work, not a game. Either way, consistency beats randomness every single time. Emotional discipline. Now, let's get real. This is the hardest part for most people. Your emotions are your biggest enemy in investing. Graham said it best. The difference between successful investors and broke ones isn't intelligence, it's emotional discipline. Markets go down, people panic sell. Markets explode, greed and FOMO take over. Look at history: the dot-com bubble in 1999, the 2008 financial crisis, the 2020 crash. In each case, some panicked, others stayed calm. Guess who came out ahead? The ones who ignored the noise and stuck to a system. Here's how you do it: set rules and follow them no matter what. Dollar cost average every month. Rebalance your portfolio periodically. Ignore the hype on social media, the screaming headlines, the ticker drama. Think of it like flying a plane through turbulence. The pilot doesn't start yanking the wheel. They stick to the system. You do the same. Control yourself, not the market. Emotional discipline isn't glamorous. It's boring, steady, and frustratingly simple. But it's what separates winners from everyone else. Practical takeaway: your job isn't predicting the market, it's predicting your own reactions. If you can stay calm, consistent, and patient, the market will reward you over time. Combine these 5 rules, and you protect yourself from market madness, hype, and panic. Invest like Buffett, stay disciplined, and let long-term wealth grow automatically. Start small, be patient, and remember, the market rewards those who control themselves, not their emotions. What's your take? Drop it in the comments and hit like and subscribe.